In the finance world, if you're an investor or aspiring to be one, of course, it's only essential for you to know terms that are relevant for investing, one of which are ETNs or exchange-traded notes. Now, if you're still not familiar with this, don't worry, we've got you covered. Hey, welcome to Stock Market Mate. Today we'll talk about exchange-traded notes or ETNs. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. What's a stock exchange? First things first, we presume you already understand what a stock exchange is, which is effectively a public market for specific equities. The next topic we'll go cover is what a stock market index is. An index is essentially something that monitors a certain area of a financial market. For example, the S&P 500 index examines the 500 largest corporations in the United States and assigns a value to each. Another example in the UK is the FTSE 100 index, which follows the top 100 companies listed in the London Stock Exchange and provides us with a value we can grasp, allowing us to say that a collection of stocks is worth X. What are ETNs? Let's return to exchange-traded notes or ETNs. Bonds are what ETNs are. This means they are a form of debt instrument that is given to investors and provides them with a set of returns. ETNs are unsecured debt securities that track an underlying index of securities and trade on a major exchange just like stocks. ETNs are comparable to bonds, however, they do not pay interest. ETN prices, on the other hand, fluctuate like stock prices. How does it work? So who are the players in this scenario? We have a financial institution here, which may be an investment bank or anything similar, as well as our investors. Over here, the financial institution will issue these ETNs to the investor, who will pay a fee and hope to profit from them. The fundamental distinction between an ETN and a bond is that the ETN monitors the performance of a certain index, such as the S&P 500. So if a specific index is configured to provide a 5% annual return, the ETN will provide a 5% annual return to its investors. But here's the strange part. The financial institution is free to do whatever they want with the money they acquire. They're not required to purchase equities in the index. All it does is promise a return depending on the index, and how it does so is entirely up to them. So we could take that money and invest it fully in Bitcoin, and no one would be the wiser as long as it pays their investors the same return as the index it monitors. If the index rises in value, the ETN should rise as well. Similarly, if the ETN's value falls, the ETN will provide less or no return at all. They are inextricably related. Now, this ETN might be highly profitable for the bank or institution that issues it. As an example, suppose an investor pays $100 for an ETN that matures in a year. The financial firm that issued this ETN takes the money and trades options or derivatives for a year, earning a 100% return. So it now has $200 from its $100 investment. However, the index that this ETN monitors generates a 10% annual return. So after a year, the financial institution returns $110 to the investor, which is 10% less any expenses. So perhaps it is $108 that it returns to the investor. However, through its own investing activities, it practically meant that they made 100% on the invested money and kept 90% for themselves. Another feature of ETNs is that, unlike bonds, they do not pay monthly interest payments to investors. When the ETN matures, they simply pay out any returns plus the principal. However, most customers do not hold these ETNs until they mature. They frequently trade them on stock exchanges with other investors because the value of the ETN will rise and fall in accordance with the index it tracks, therefore establishing a market for them just like conventional equities. So hopefully that makes sense. Things affecting the ETNs. Let's take a look at some of the other factors that can influence the value of these ETNs. One factor is the credit rating of the institution issuing them. If the institution's credit rating falls from AAA to AA, it may have an influence on the value of this ETN. Furthermore, suppose an institution did not issue an ETN for a year, reducing supply and potentially increasing the value of existing ones. On the other hand, if lots are released and there is more supply than demand, the price may fall. As a result, there are numerous factors that can influence its pricing. You've probably heard of ETFs or exchange-traded funds. These are comparable in that regard. They keep track of specific indices. However, they differ in that investing in an ETF entails purchasing a set of equities that it supports rather than merely getting a return if it performs well. Why do people invest in ETNs? So why is it that people invest in ETNs? Reduced tracking error. For starters, there are fewer tracking errors. So what does all of this mean? Because the ETN's return completely matches the returns of the underlying index, it means you're receiving a very good match to a certain index if that's your investment style. It differs from ETFs in that, with ETFs, portfolios must be regularly rebalanced to match the index, which may result in occasional inaccuracies. Tax benefit. The second advantage is a tax benefit. ETNs do not provide regular interest payments like bonds or dividends like ETFs or other stocks do. This means that investors will only be taxed on capital gains when the ETN matures. This sort of long-term capital gains tax is usually smaller than the short-term capital gains tax that is required to be paid on any interest payments made to the investor in several jurisdictions across the world. We hope that was clear. Exposure. The third interesting part of ETNs is that they enable specific exposure. They frequently provide greater access to specific indices than ETFs because the ETN just promises to pay the index's return rather than investing in the index's underlying stocks. Risks for ETNs. Credit risks. ETNs, like unsecured bonds, rely on the creditworthiness of their issuers. If the issuer defaults, an ETN's investor may receive cents on the dollar or nothing at all. An investor should keep in mind that credit risk can fluctuate rapidly. Lehman Brothers had 3 ETNs outstanding at the time of its bankruptcy in September 2008. While many investors sold these ETNs before to Lehman's demise, only $14.5 million remained in the 3 ETNs when the business fell. Those who did not sell paid pennies on the dollar. Liquidity risk. ETN trading activity varies greatly. Bid-ask spreads can be extremely wide for ETNs with relatively little trading activity. In March 2021, for example, one ETN had an average spread of 11.8%. Issuance risk. Unlike ETFs, where the supply of outstanding shares fluctuates in response to investor demand, ETNs are exclusively produced by their issuers, who effectively issue new debt each time they generate extra units. At times, issuers may be unable to create new notes without violating bank authorities' capital requirements. Furthermore, banks frequently put internal limits on the amount of risk they're willing to accept from ETNs, and issuers have stopped issuing new notes that have grown too large or too expensive to hedge. Investors that pay a premium for ETNs pay a higher price than the note's value based on the performance of the underlying index or referenced asset, risk losing money when issuance resumes and the premium disappears, or if the note is called by the issuer, who refunds just the indicative value. Closure risk. An issuer can effectively close an ETN in a variety of ways. An issuer may call the note, sometimes referred to as accelerated redemption, by returning the note's face value with fewer fees. However, not all ETNs include terms allowing for rapid redemption in their prospectuses or pricing supplements. The issuer's other option is to delist the note from national exchanges and suspend new issuance. When this occurs, ETN investors are faced with a difficult decision. They can either keep the note until maturity, which might take up to 40 years, or trade the ETN in the over-the-counter market, where spreads can be considerably greater than on the national exchanges. There are numerous other benefits and drawbacks to ETNs, but hopefully this has given you a decent basic understanding of them as financial products. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!